Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both technical and fundamental, driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next half hour, 40 minutes or so. A lot to get through, really busy week. We'll be looking at our usual template, if you like, actually just seeing where markets are currently. A couple of quick thoughts on the bond market, actually, which everybody's looking at, this curve inversion, 10-year yields, US 10-year Treasury yields going beyond 4%, and obviously now just pulling back, actually, Friday and today. A key driver for markets, that is for sure, so really worth looking at those from time to time. I would recommend we'll look at equities, of course, how they shaped up end of last week in the US, and some of the technicals around the major indices. We'll then whiz through, hopefully, just a few pieces of data from last week, the key ones that we see, actually, and a few charts, actually, which really show you what's happening with some of that data. Before then, looking at all these events for the coming few days. For the dollar, we'll look at the DXY, of course, but we have the Fed Chair Powell speaking on Tuesday. We then have the all-important non-farm payroll report, the US employment report, the monthly one, which is on Friday, of course. And between then as well, we do have three major central banks, the RBA overnight tonight, that is UK time, of course, Bank of Canada on Wednesday, and then the Bank of Japan, actually. So Governor Kuroda's last meeting after a 10-year stint at the helm, that comes in overnight, sort of Thursday, Friday. So a lot going on. Expect, I would think, a lot of volatility. There's so much information potentially to take in for markets in the various currencies, for sure. And this is obviously proceeding then next week, where we get US CPI data, really important, next Tuesday. Before then, the following week, we get the biggest central banks probably for everyone. So the Fed on the 22nd of March, and then also the Bank of England and Bank of ECB, sorry, the European Central Bank. So let's get to it. Just our general look at how currencies are shaping up for the year to date. You can see on the left-hand side, that was actually last week's. So I just thought I'd show you some sort of relative differences. So the right-hand side bar charts are just today's pricing, really. So you can see not a lot of change actually between the top and bottom. In fact, just a few sort of different outperformance, underperformance in the various currencies, all against the dollar, of course. So the dollar still assuming it's thrown, if you like, king dollar, whereas certainly the yen has, brought slightly something back, as well as the Kiwi dollar, you can see, but still struggling as the weakest performer of the major currencies. Before I get on to all these charts from last week's data, or just a few charts, markets have really entered this week on relatively steady footing, I'd say. Strong end to last week from stocks. They continue to hold up really quite well, despite this recent big rise in bond yields, and are kind of providing some support to pro-cyclical currencies, although the Aussie and the Kiwi actually suffering this morning. Kiwi down 0.72%, actually, the Aussie down 0.67%, but the euro dollar, or euro even, is pretty flat, really, with the dollar at the moment. This comes after then the Chinese growth target really has been the key headline from overnight, really, from Asia. A slightly lower than expected Chinese growth target for this year at 5%. I think 5.5% to 6% had been expected. That hasn't really given too much support to the dollar. It's a kind of rather modest goal, actually, and it's really seen as restoring Beijing's credibility after missing last year's target, which was around 5.5%. By that miss was by a wide margin for the first time ever. So really, trying to restore China's credibility, really running the economy. It's also suggested that there might not be any large stimulus measures going forward. Plus, as well, probably indicates the government is seeking to strike a kind of balance between supporting the economy and strained finances, as well as then preventing any sort of spiraling in commodity inflation. I mentioned we'd have just a couple of thoughts on just the bond markets. Don't want to get too complex here, of course. Here you just got a chart of the US 10-year Treasury. That's sort of a global proxy, I keep on saying, for borrowing costs, if you like. And all about this, of course, this recent key theme, which is rates going higher for longer. Whether now, because we've been talking about it over the last few weeks for sure, whether we're now sort of running into the top of that story, the top of that theme, and we can trade that in some way. The sort of dollar advance has paused slightly, which we'll look at. And same with these yields, are sort of kind of drawn to 4% in the 10-year yield. We hit that, as you can see, Thursday, actually, we got to 4.089% actually, and then we've just pulled back. So always you've got to think at these key psychological levels, whether we test those and then we pull back. This is in yields, of course. So the terminal Fed funds rate moves similarly higher, of course, roughly around just below 5.5% now. So 5.45% or so. That attaches a 40% probability to a 25 basis point hike in July. So that follows then 3 25 basis point hikes through March in a couple of weeks, May, and then June as well. Certainly that's coincided, as I've said, with this upward pressure in the US 10 years. And the 2-year as well has hit the highest level since 2007, actually, at 4.94% last week. But then those yields, as I say, have pulled back. So prices in bonds have gone higher. Remember, yields move inversely to prices. And of course, they've risen all with a series of strong data, forcing the Fed to be more aggressive, to raise rates, obviously, to cool inflation. And the economy generally. Even at 4% then for this US 10-year Treasury yields, it's almost 150 basis points below the market projected funds rate. And that's actually unprecedented versus previous cycles over the past 4 decades. You have to go back to the sort of 1970s, so way back then, to see something different. And even then, the biggest discount is when the Fed is about to cut, so not as now when the Fed is still hiking. So really interesting idea there, just about dollar strength potentially, and what happens, this difference now in this most aggressive rate hike cycle that we've seen pretty much ever, or for decades at least. And it's also worth probably pointing out about this curve inversion. If you remember, that's the difference between the 2-year yield and the 10-year yield. Don't want to get too complex here, but we're probably going to see deeper inversions. So that means where they trade wider. So the 10-year yield is less than the 2-year yield, which means the curve is inverted. And yes, as I say, we're probably going to get a bigger discount going forward for the next, well, in the short term at least. And then we have to think about what happens after that, because that won't last. And the most striking changes probably will be in the coming quarters, where you get a switch of that, a disinversion really. So we go back to where longer term rates go higher first, and then later on you get near term rates, so that front end, if you like, that's where they collapse lower as the peak in official rates is eventually discounted with more conviction. The thing is, of course, that we're not there yet, so therefore we still potentially have this inversion going forward. Just to thought I'd run through that briefly. Hopefully that makes sense. If it doesn't, then please do let me know. I'll give some answers in the chat box, or going forward, just send an email if you can, or whoever, or just a question later on, hopefully. Okay, enough of the bond market. Let's go to stock markets. Equities, US stocks, as I said, they notched up decent gains, the biggest one-day gain actually in at least a month after these treasury yields, they retreated from their highs. That helped the S&P blue chip 500, the S&P 500, the blue chip index ended a 3-week losing streak actually, and closed 1.5% higher on Friday, leaving it up 1.9% on the week. The tech-heavy NASDAQ, that surged over 2% on Friday, advancing around 2.68%, I think, over the past 5 sessions on Friday. So both indices really rebounding from the steep falls from the previous week. And interestingly, of course, we have interest rates going higher, and basically earnings going down. So not a great combination for stocks that are still expensive, really. Obviously, we've had 3 down weeks in a row, which kind of meant we were due a bounce, really, probably. Because essentially, as we know, the worst of the bear markets, they don't go down in a straight line, just as bull markets don't go up in a straight line. So just a couple of points there. For the weekly then, the S&P 500, we can see, yes, we sort of bounced off this long-term trend line resistance, now support potentially. We've also got that long-term fib level from last year's decline around 38.2, the 38.2, sorry, fib levels at 39. Where are we on the 50? Sorry, the 38.2 is at where are we? 39.58 or so. So we've bounced off that level, really. You can see there on the weekly candle. And just then moving to the daily, again, that trend line support resistance, 200-day moving average, huge levels we've talked about consistently for the last few weeks, just below 4,000. So a key psychological level, of course. The 200-day moving average at 39.40, you can see we've bounced nicely off that. We've sort of put in here this sort of falling wedge pattern, and then obviously this break to the upside, also broken through the 50-day moving average at 39.87 there. Constructive sort of push higher, rebound really effectively from sort of key zone of support potentially. Let's look at the NASDAQ now. So tech heavy, of course, support, big support at the, we just go to the weekly, actually, big support at the, where are we? The 50% mark out actually of the pandemic rally. That's at 11,768. And then you've also got the 200-week moving average. That's at 11,650. Oh, no, 11,680 now, actually. And then obviously this falling trend line support potentially, that's a bit lower. So again, sort of primarily the 200-week moving average, big widely watched indicator of support, and we bounced off that. And then if we go to the daily, you can see, yeah, strong bounce from then the 200-day moving average at 11,902, and then pushing back above actually the December sort of pivot highs, really. We're back to sort of 12,500 potentially. Just want to point out then, what else? The Dow very quickly on the weekly. You can see that breakdown from sort of the tight ranges that we saw, sharp break as we thought, but we found support actually at the 50-week moving average. Also, the halfway point of the 2022 rally, that comes in around, where are we? Around 32,834. So we've bounced off that. And then in the daily, you can see, yeah, nice bounce towards then. Didn't get to the 200-day moving average, through the 100-day moving average, and then up to potentially the 50-day. That's at 33,528. Just interesting, just pointing out, we always look at the DAX now. Really decent positive move. You could see on Friday, potentially pushing us up to the top of the recent range at least. Didn't quite make a new high. The recent high is 15,656. We got to 15,638. And then we just sort of turned lower. So really interesting whether we can close above that sort of 656 level, sorry, and then potentially more upside, because that does look like as though it's just bullish consolidation in this long-term uptrend. Although tracking sideways for more and more days does mean whether we do fail around this level or not. So key will be the close. Whether we close above that. You can see on the weekly, it really was a strong close on the weekly. It looked as though we were going to push, or potentially we will push up above to new highs for the year, and not seen since, going back to probably January of last year. There you can see that's on the DAX. Obviously that strong support's come about, China reopening certainly, and then Europe obviously some decent data, ECB being hawkish potentially as well there. So that resilience sort of a few months ago at least surprising many, but now really clear preference for European stocks, and certainly as well they are there's a clear preference for value stocks, which is obviously Europe is heavily weighted to that rather than say growth stocks, which are seen in the Nasdaq, for example. Just the FTSE as well, UK index, interesting really. We're just drawing in this sort of medium-term support trend line, if you like, and we're just sort of oscillating around there, just falling below that. We've got the 7903, which is the 2018 highs, previous highs, long-term highs there, and we just can't quite keep hold of that today, selling off today. So interesting whether we can keep that 28th of February low at 78.54. Otherwise, then we sort of roll over back to sort of 7,800 or so. So an interesting level there with that sort of long-term trend line support or resistance. Okay, moving on to just very quickly last week's bits of data. We had Chinese PMI rebound, really. Non-manufacturing gauge that actually rose well into expansionary territory, 56.3. This chart here, we've got the manufacturing PMI that came in at 52.6, so the highest level actually since 2012, and that was from 50.1 in January. Then it lifted the composite. I don't have that chart actually, but manufacturing and non-manufacturing services, the gauges together lifted, went up to 56.4. Obviously, when diffusion index goes above 50, it signals expansion. And generally, the details were all relatively strong and really feeding into this narrative, this theme that the 2023 China recovery certainly is the real deal. Also, I've put in actually a global PMI there, and you can just see we did tack below that 50 line, contraction and expansion, and we've just sort of touched it again, first time since August of last year. So that's the sort of global picture, if you like. Then we had the ISM, the US data, really important data of manufacturing. That rose to 47.7 in February. So does remain in contractionary territory, but it did break an 8-month-long decline. But perhaps more interestingly and not surprisingly, actually, what most of the attention in the market was paid to was the actual prices paid element. So that's a sub-index, and that jumped to 51.3 from 44.5, which could suggest that producer prices are rising again, instead of course vice versa, although at a slower pace. And you can see that on the chart here. So kind of a pricing measure, inflationary measure again. Important though to put some context to this sort of data here. The market focused on it quite a lot, we think, but again, for context, In the 2 years to June 2022, the height of the pandemic inflationary wave, if you like, the index averaged 78. And indeed, actually, in the 5 years before the pandemic, so up to the end of 2019, the average was still 56. So, of course, lots of focus on inflation risks whenever they appear, but we kind of have to be realistic as well about the significance potentially of, well, this signal at least. And with respect to businesses, it's also worth mentioning that taken together, think about other data, durable goods in the US, regional business surveys, they point to kind of slightly softening in business investment. Okay, also one other piece of data from last week was Eurozone core inflation. So we've got a chart here. You can see the sort of lighter color is core, so that strips out the volatile elements like food and energy. And then you've got the headline, which is obviously turned lower. And you've got this divergence. We've talked about this before. Lots of people focus on the headline. Really, that's obviously turned down with energy costs coming down, falling sharply, of course, this year over the last few months. But you've still got, when you strip out that, you've got, especially in Europe, generally actually, but Europe we're looking at now, obviously core inflation is still on the rise. As I say, that went to 5.6% year on year in February. Core goods 6.8, services 4.8. So they're touched record highs. And core, the main core index you can see here, that's a record high as well. So much higher than expected. That was at 5.3%. And that was the previously revised number. If you remember, that got revised up to 5.3%. And it's really, yes, whether inflation is entrenched for policymakers. It's all about core. It's all about whether, prices are entrenched. And it appears really that it is still this headache of high inflation, high core inflation, really. And that will potentially remain an issue for most of the year. All the country prints, so those are all the ones in the Eurozone, if you like, they were released earlier last week. Actually, they all came in above expectations. Probably big highlight was the headline, really. Germany 9.3% against 9% expected. And really then it turns the focus or really it just shows you the ECB is really unlikely to slow the pace of tightening until, we get any signs of underlying inflation peaking. For the ECB pricing, then markets, they see a further 150 basis points by year end. So that's at least, or we should expect at least 2 more 50 basis point hikes in March in a few weeks. That's nailed on. And then in May as well, there's no meeting in April. And then, of course, depending on the trajectory of inflation, market consensus then forecasts another 25 basis point hike in June, and then potentially as well at the following meeting, which is in July, end of July. So I was just checking when that was. We don't get a meeting in August, so then the following one is on the 14th of September. So potentially the next few meetings, we're getting rate hikes again, 150 basis points from here on till the end of the year, priced by markets. We shall see. Just looking at euro dollar. Just let me pull up the chart. Been tracking kind of sideways, sort of bounced from that low at 105.37. You can see there, that's the February low, year-to-date low in January, then was below here, 104.81. Potentially, if we do roll over, then certainly that's the first line of support. But potentially then there's a big level sort of below here, 104.60. That's the big fib level, 38.2 level of the sort of 95 to 110 rally. If we can push up, then obviously we got last week's high at 106.91, and then above that we've got that 50-day moving average around 107.20. 2025. Okay, over to this week's main events. Firstly, we have Fed Chair Powell. He'll be delivering his semi-annual monetary policy report to Congress this week. He starts with the Senate Banking Committee on Tuesday, and then he'll likely repeat his remarks to the House Financial Services Committee on Wednesday. So really, it's all about the Tuesday speech that he gives. Wednesday, just repeating those remarks. Really, nothing really changes between the 2 days. It's a twice a year event, semi-annual, as we've said, and that has seen actually Fed chairs in the past give views on the outlook, and those being market moving. So a key focus for markets initially on Tuesday, and obviously that then comes ahead of the key economic data release on Friday, the NonFarm Payrolls report, and then I've said, of course, CPI next Tuesday, March 14th, and then the Fed the following Tuesday, Wednesday evening, UK time. Certainly leaves some scope for Fed Chair Powell to possibly alter his recent messaging to be really more in line with some of the other Fed officials we've heard from recently. And we do get the Fed blackout period, of course, before the Fed, probably 10 days before the Fed meeting over the weekend, probably this weekend coming, actually. So last time for him to really possibly alter his sort of more sanguine look, actually, if you like, his more relaxed look, which he took at the Fed press conference last time out. We've obviously had now a hot run of data in January, February, seen this hawkish repricing of the Fed's expected rate hike trajectory, if you like, and then with this sort of terminal rate now close to 5.5%. Expectations then really for Powell's message to really likely remain data dependent. He'll reiterate Fed's job is really still working hard. There's still work to do, potentially managing inflation that is not yet, that job hasn't yet concluded, if you like, despite progress being made. Certainly any hints that he gives as to whether the Fed will deviate possibly from a 25 basis point rate hike, so bigger 50 basis point rate rises, that would certainly move markets. You kind of have to think that the bar is quite high from the Fed moving back to 50 basis point hikes, really having then dropped to 25 basis point hike recently. That bar certainly then seems to be quite high. But he also possibly could imply, obviously, the new FOMC dot plots that we get published in a few weeks' time from December. Potentially, he might signal that they've got to go higher, which he has talked about actually recently. Remember that average dot plot in December was at 5.1% only. So you kind of think that is definitely going to move higher. Whether he hints at that and gives any sort of clues as to where, then markets will really seize upon that. Actually, I'll just go, before we look at DXY, I'll just look at the other big risk event is, of course, non-farm payroll. I have got this graphic here that has got all the info on really where the market expects the headline payroll number to be at 215,000. You can see there in February. That's obviously nearly from nearly triple the forecast, 570,000 blowout. Report in January. If consensus is realized, then it would be lower than that 215 pace of the previous, 3 months, 6 months, 12-month averages, actually 356, 349 and 414 for the 12-month average respectively. So 215,000 or so would be lower, and certainly lower than that 3-month average of 356 or so. And that then will probably be a signal for markets possibly to reprice the pricing of anyway the March meeting. Analysts have really argued, or economists have argued, that the January upside may have been a result of seasonal adjustments, and that could be a negative factor actually now in the February data. The unemployment rate, that's forecast to have risen by 0.1 to 3.5%. You can see there on the left-hand side, the Fed projects this rate will peak out at 4.6% in 2023. Although remember, they'll update those projections in a couple of weeks' time. The recent data show that job openings remain elevated, so just bear that in mind, of course. And then obviously trying to get a handle on compensation pressures really being impacted by high inflation, really. So there'll be a lot of focus on the average hourly earnings data. That's the wage growth, basically. A strong market, obviously a strong jobs market, typically suggests higher wages, which are, of course, one source of inflation. The street then, they expect 0.3%, so that's no change from the pace seen in January, while average work week hours they're seen narrowing slightly. But then the annual average hourly earnings measure, you can see that should increase to 4.7% from 4.4%. So an increase is expected, but again, that is expected, but it's due to pretty much easy base effects from the previous year. So remember that, of course, when the data comes out. Generally, the current pace of growth, of course, is still uncomfortably high for the Fed. And underlying, that said, of course, though, underlying wage growth does appear to be moderating across other leading indicators and other measures. So, focus on the wage growth numbers, and then obviously the headline number will be volatile, no doubt. After that blowout number, the seasonals to take into account, different adjustments as well on the data collection. So I did see, actually, it was interesting, one of the big investment banks talking about really having no clue on the headline number for February, just because of that blowout number. And generally, if you read across the sort of spectrum of guesses, if you like, then really they are, it is very tough in any normal circumstance to forecast the headline non-farm payroll. That's why we kind of look beyond it, and you look at wage growth. But then also, I think it's important to look at revisions, always key, and especially now with this 517 number, and whether there are bigger revisions to that or not. Just touch on DXY, then you can see sort of tracking sideways, really. Support below 103.82 we still have in there. That's a long-term spike high from where are we? Back here, look, in late 2016, 2017. We've still got it on there. So that's support, possibly nearer to home, probably the 50-day moving average at 103.37, and then upside probably capped by end of February highs at 103.35, and then you've also got that 100-day moving average at 105.44. That's in for the DXY. Okay, just then the 3 central bank meetings. Firstly, we go to the RBA. Just let me grab, we've got a preview of that, another graphic. Consensus expects 25 basis points, so that'll lift the rates to 3.6%. There is a non-negligible chance of rates staying unchanged. That's around 18-20%, I think, chance. Potentially they don't move. Just thinking about rates, generally they've lifted obviously from a record low back in May 2022, 0.1% that was. And then we've seen moves at each monthly board meeting, including 50 basis point hikes for the 4 meetings from July to September. Then the RBA slowed the pace of tightening in October back to 25 basis point increments, with policy moving really into contractionary, the contractionary restricted territory, if you like. Since the last meeting, data has been mixed. We've got some data on here. So you've had that slowdown in GDP, which kind of revealed kind of a weak consumer impacted by the rising cost of living and elevated interest costs. Of course, that is despite then nominal wage gains, and a further reduction in the savings rate. We've also then had that CPI number. It did drop, but still stands at 7.4% year on year. That's way higher than what the RBA will be comfortable with. Kind of confirms that they'll go 25 basis points at this meeting. They really want to see confirmation of a downward trend in inflation, and other data really concluding to a slowdown is underway, and not just kind of a reversal of seasonal spikes. Before then, they sort of stopped this 25 basis point per meeting tightening strategy. Remember, their target zone for inflation is 2 to 3%. So whether the tone of the statement will match then this hawkish repricing you've seen, or markets have really pushed with the peak rate now around 4.1%. So potentially we go to 3.6 at this meeting. We still got 50 basis points of tightening potentially to come. Certainly that's what local banks, ANZ, other banks, CBA, I think, pointing, or they've readjusted their peak rate for the RBA to around 4.1% or so. So possibly then after this 25 basis point, 2 more 25 basis point hikes to come. But should point out as well, some central bank speakers, I think the Treasury Secretary, he mentioned about possibly inflation peaking. Interesting for the RBA. If we just pull up the Aussie dollar chart. Yes, well, interesting sort of tracking sideways. You can see quite a few days now, sort of clinging on to the 100-day moving average. That's at 67.52. The 200-day moving average capping upside, really, that's at 67.87. So potentially we do roll over, possibly. The lows, recent lows at 66.94, and then we've still got this sort of pivot low, if you like, from back in July at 66.81. So interesting support, which has sort of kept prices stable and acted as I say, support around that level or so. But the more we track sideways, the bigger range expansion we should see if we do break out. That's in Aussie dollar. Next central bank meeting is the Bank of Canada. Kind of less exciting, really, but interesting just to see the different phases, if you like, of where central banks are. RBA still hiking slightly. Then the Bank of Canada expected to pause. And then we'll touch on the Bank of Japan, obviously, which is kind of nowhere near it. But just interesting seeing these differences, and therefore why some currencies are not doing as well. The yen, of course, prime example, and potentially the Canadian dollar as well going forward. Because, as I say, the Bank of Canada expected to pause, keep rates at 4.5%, after it said in January that if economic developments evolve broadly in line with its outlook, then it expects to hold policy at its current level while it assesses the impact of the cumulative interest rate increases. And well, we've come from 0.25% in January of last year, and then we've obviously the Bank of Canada's lifted rates by 4.25% in just 8 meetings. So that's sort of average of over 50 basis points per meeting. You remember actually they did a 100 basis point move, sort of middle of third quarter last year, and now rates are at 4.5%. So yes, kind of instructive, logical. They see and want to assess the impact of all these very sharp rate rises. Data-wise, we had GDP actually showed the economy grew less than expected in the fourth quarter. In fact, it stagnated, as I've put here, actually, in annualized terms, contracted 0.1% actually in December. That was worse than the Bank of Canada had forecast, and really kind of cemented the pause, really. Also, we've had CPI that fell below expectations of 6.1%, with a fall, lowest print since February of last year. The Bank of Canada's target band is 1 to 3%. So you kind of possibly think a fall will happen within this year. And that kind of, again, also argues for a pause by the Bank of Canada. Sorry, I just put in there. Well, prior months was 6.3% there, and we fell to 5.9%. But then, of course, you've still got sort of strong job gains. January was 150,000. So that'll be interesting as we do get Canada jobs out on Friday, this Friday, the 10th. So North American sort of jobs day to day on Friday with the NFP, and then also the Canada jobs numbers out. I think from memory around 10,000 is the estimate, but I have to double check that. So yeah, Bank of Canada, will be interesting. No hike expected, meant to remain on pause. And if you just pull up the dollar CAD charts, we've not had much data, really, not much domestic news. The CAD's really been tracking the ups and downs of the dollar, dollar CAD, of course, as well as trading the broader risk move. Interesting, actually, we talked about the correlation of the loonie with equities, and that's kind of weakened over recent weeks. Stands, it's the weakest, I think, on one Canadian bank's measures since last July. That correlation with equities, it's still, let's not forget, the strongest correlation with stocks among the major currencies, but it's just sort of pulled back slightly. The CAD decoupling, if you like, with equity trends. Other drivers for the loonie, just generally talking about it in terms of trade, that's kind of stable. That means with commodities, that weakened last year, but now it's relatively stable. And so, dollar CAD really tracking in a range, slightly neutral, really. We need to break up, probably break, that 136.65 level to the upside. That remains solid resistance, really. And then you've got this resistance around sort of just below 137 or so, sort of reinforcing that resistance level. And then potentially, if we move down, probably Friday's low, 135.55, then potentially we get towards sort of 135 level. But will be interesting. Bank of Canada meeting, that is on Wednesday. Then finally, we get the Bank of Japan meeting. A lot of speculation about whether anything happens there. They're expected to keep policy settings unchanged. Likely to leave rates at negative 0.1% and then maintain its QQE policy with yield curve control. That's to basically target their yields on the 10-year Japanese government bonds at around 0%. As I mentioned, this will be the last meeting with Governor Kuroda at the helm, whose term will then end in early April. While the two deputy governors as well, they're finishing their terms this month. If we just cast our minds back, the Bank of Japan obviously defied increased speculation for a policy tweak at its last meeting in January. It maintained its rate and parameters of yield curve control, and then also stuck with forward guidance on rates, saying it will continue with large scale Japanese government bond buying, as well as reiterating that it will not hesitate to take additional easing measures as necessary. We had an outlook report, which was kind of as well dovish leaning. Real GDP forecasts were cut across the projection horizon, and core CPI estimates for this fiscal year 2023 and 2024 remain below the BOJ's target of 2%. and that really is the level that could have paved the way for policy normalization. So since that meeting, rhetoric sort of has been dovish, really. Kuroda stated he's resolved to keep ultra-loose policy. Bank of Japan expects core consumer inflation to slow beyond 2% in, as I said, those fiscal years 2023-24. While a deputy governor, he also noted it's appropriate to maintain ultra-loose monetary policy, although he acknowledged that there are some drawbacks to yield curve control policy. So an adjustment kind of seems unlikely. But yeah, as I say, speculation around Governor Kuroda's last meeting, pulling a rabbit out of the hat, if you like, after his 10-year stint. That actually began with the announcement of QQE way back in April 2013, so 10 years ago, really. And markets then looking now, of course, to the next new chief to steer the Bank of Japan really towards an exit of its ultra-loose policy. Ueda obviously been named as the nominated successor. Doesn't really seem to be in a rush to normalize policy. He's noted recently current policy is kind of appropriate. Japan still needs more time for inflation to sustainably hit the 2% target. And as well, kind of stated recently it's appropriate to continue monetary easing from now on, and suggested that the Bank of Japan would either need to move towards normalization or must consider ways to maintain the yield curve control depending on if inflation significantly improves or not. All pretty logical, really, but not in a rush to change, you would kind of think. Interesting, a recent source at the Bank of Japan, I think, noted they would prefer to monitor the impact of that earlier tweak in December to see how that works out for now. So just moving finally to dollar yen, you could see broke out of that descending channel, nice series of high highs, high lows, but sort of got possibly a rising wedge here, so potentially then rolling over. We've hit resistance, if you like, at the 200-day moving average at 137.33, also a fib level, and then the 100-day moving average closer to home, if you like, at 136.48. So possibly rising wedge. That's a reversal pattern seen in bear markets. So it kind of shows up when prices move upwards with prior highs and lows kind of converging in a single point, sort of an apex, and then we fall down, we fall over, roll over, really. So potentially then going back towards 135 or so. All depends on, well, Bank of Japan, also the non-farm payroll, because then that will shift 10-year treasuries, which have a major correlation to this major dollar yen. Okay, I think we'll wrap it up there. Thank you so much for listening. We'll be back same time at on Monday of next week. Looking forward to reviewing all these key risk events, and then obviously looking ahead to the US CPI data next Wednesday. Okay, take care out there and speak to you soon.